Okay, here we are with a bank rec problem. If you're looking for another bank rec problem to practice with, there is another video of a bank rec problem for the college accounting course, and that one will be very similar concepts as well. So if you want extra practice, go ahead and check out the college accounting playlist, and you'll see another bank rec problem there to practice as well. So we're going to go ahead and do this bank rec for Archer Spy Supplies. And we're starting off with the business. They just received their October 31st, 2024 bank statement from the bank, and the statement shows an ending balance for $910. Listed on the statement is EFT rent collection for $440, a service charge for $7, non-sufficient fund check totaling $50, and a $23 charge for per checks. In reviewing the cash records, the business identified outstanding checks totaling $404 and a deposit in transit for $1,800. During October, the business recorded, they made an error. They recorded $260 check by debiting salaries expense and crediting cash for $26. So they left off a zero. The business cash account shows an October 31st balance of $2,144. So we're going to go ahead and prepare this bank statement, and I'll go through all these items that were in that paragraph as we start adding them to our bank rec. So we have, first we're going to start doing the bank side. So we do the bank side we only do the bank side to make sure you have accounted for all the timing differences, and then you tie out to the adjusted book balance. So this adjusted bank balance needs to be equal to the adjusted book balance. And when that happens, then we know pretty sure that we accounted for all the timing differences. And so when we get there, all these adjustments within the book side is what we're going to need to do journal entries for. So we're going to just do the bank side just to get an adjusted balance, and that balance will need to be the ending balance, the adjusted balance for the book side. So let's go ahead and talk about some items that the bank doesn't know about yet, timing differences that the accountant knows about. So when we're going back to here, let's enter in our balance, our statement balance, because that's our starting balance that we're going to adjust. And that was 910. So that was up here. The statement shows balance of 910. So why don't I just circle it for you? All right. So that's what I plugged in. All right, now let's go ahead. So all these items listed on the statement, that's for the book side, so we don't need that. But yeah, right here, this sentence here is what we need to pay attention to. So in reviewing the cash records, the business identified outstanding checks totaling $440. So the accountant for Archer Spy Supplies was looking at the cash account and saw that, hey, looking at it, comparing it to the bank statement, and said, hey, these checks are missing. And those checks that didn't clear the bank yet add up to the $440. Those are outstanding checks. The accountant knows they wrote the checks to those vendors, and when you write the check to those vendors that you're writing, you're going to make the journal entry to record that expense or whatever. Maybe it was a purchase, whatever it is that you wrote the check for, you recorded it and deducted cash by that amount. And looking at the statement, these checks aren't listed there on the statement yet, so they didn't clear the bank yet. Maybe the vendor didn't go to their bank yet and deposit their check. Maybe it's just timing difference because it takes a few days for a check to clear the bank, and maybe those are going to clear on November 2nd, a couple days later, and that will be in the next month. So we need to account for those because they really did happen. Those checks were written, and so we need to adjust this balance, this 910, by deducting it, by lowering it by those checks that were actually written. So let's go ahead and circle this so we know where you're at. Those are our outstanding checks that we need to deduct. And so we're going to write that in here. Okay, perfect. Next we have, I already wrote it in, I see, but our deposit in transit. So here we have deposits in transit for $1,800. So what happened is the accountant received customer deposits, and that was totaling from their customers. They made payments. So Archer Spice Supply received money from the customers, and it was totaling $1,800. Maybe the accountant went on, or whoever went on October 29th to deposit to the bank the 1,800, and those checks didn't clear from the customers, didn't clear yet. Okay, then maybe they're going to clear on November 3rd or something. They take a few days. And so when the bank statement was done for as of October 31st, those deposits are missing. We know about them because we got them from the client and we did a journal entry recording that we got that money. But the bank doesn't know about it yet. So those are in transit. They haven't cleared yet for the bank side. So we need to add them to the bank's balance because we really did get that money from those customers. So let's go ahead and add 910 plus 1,800, 2,710. Okay, and then we have outstanding checks for 440. So there we go, subtract, we're deducting. And so our adjusted bank balance is 2,270. Okay, so we want to make sure, we're going to circle back and make sure that this equals our adjusted book balance. We know we accounted for all the differences if that occurs. So we'll get back to that in a minute. Let's go ahead and now adjust the book side. So I'm going to just erase these circles so we can now start talking about the book side. So what we need first is the beginning balance for our books, and we're going to start adjusting that balance. So let's see here. It was saying the books cash account on October 31st balance is 2,144. So that's our starting balance. We're going to start adjusting that balance for some timing differences. All right, let's go ahead and start them. So I had said we're going to go ahead and look at this whole section here because that is giving us everything that was on the statement that accountant noticed and said, hey, I didn't record those yet. And for the first one is electronics funds transfer of rent collection. So the bank collected $440 from a customer directly, so electronically. And so that was a written collection from a customer. And so we're just going to go ahead and write that in there as a collection that we didn't record yet, and we need to include. Okay, perfect. And next we have is a service charge. Okay, for $7. So we have a bank fee, a service charge that we'll need to take out. We didn't know about it until we saw the bank statement. So let's write in our service charge, $7. Oops, they want it here first. Okay. Next one we have, so that one's done. All right. Next we have is an NSF check for checks totaling $50. So we had checks that bounced. So we thought we got this money. Archer Spice Supplies thought they got money from these customers, and their checks from those customers did not clear. They bounced. They didn't have enough money or something, and so the bank didn't actually collect the $50. And so we didn't find out until we saw the statement that those checks that were totaling $50 we thought we had money for didn't actually. So we'll have to call up those people eventually and say, hey, you still owe us money. We're going to have to put it back into accounts receivable, saying that we're still looking for it from those customers. So we're going to have to decrease our balance by $50 because this has the $50 included in it, and we really don't have those $50. So let's go ahead and do that. Next, we have a $23 charge for printed checks. Not too bad, it's just another bank fee. Cool. All right, the next one's a little trickier. The next one we have is that error that we need to do. So during October, this sentence here, the business recorded a $260 check, and they accidentally left off that zero. They recorded it as a debit to salaries expense for 26 and then a credit to cash. This is what the accountant did, or whoever did, and it really should have had a 0. So our salaries expense is too low, and our cash account, we didn't take out enough, right? We're missing, well, 260, and they only recorded it for 26. It was supposed to be 260. And so we're out of balance by how much? By that difference amount, which is 234. We did the math. 260 minus 26. We're missing $234 in salaries expense, and we're missing $234 that we should have taken out of cash. So our correcting journal entry, which we're going to do shortly, but let's just do it so it makes sense. We already have this one in here, so we'll leave that one alone. We're not going to go back and fix it. Instead, we're going to make another journal entry for the additional amount that should be done, which is the difference of 234. And I apologize. This is why I type, because my handwriting is awful. I'm left-handed, and I use that as my excuse for having sloppy handwriting. So that really should be our corrected entry. And we're going to go ahead and do that, but we can see here that we need to take $234 out of our cash account. So let's go ahead and do that. Oops, wrong spot, right here. And I think how your book does is calls it correction of book error. All right, we'll add up all 4 of these things. Let's see if I can get a calculator up for us. Probably by the time I get the calculator over, I could have added it in my head. All right, here we go. 7 plus 50 plus 23 plus 234, 314. So that's what we need to deduct total of. All right, I can see I forgot a subtotal up there. It looks like they want me to do a subtotal of adding. So 2144 plus that electronic funds, that's 2584. And then now that 2584 minus 314 hopefully will be that 2710. And 2,270. I don't know what I was saying there. There we go. So we can see here we do balance. So we accounted for all the timing differences. So this all here, all these additions and these 4 deductions, we're going to have to do journal entries for. All right, so that's up next. Let's go ahead and do that. We already did one of them. Oh, I can see I have my journal entries in already. Let me pause it. Okay, the answers are removed. Let's go through it together. So we have, first we want to record that electronic fund transfer collection that was for $440. So on October 31st, we need to do an adjustment. We need to increase my cash by $440. So that's that first one. Let's just leave a check mark for that one only. So we're going to record this one first. So an increase, an addition to cash for $440. And what was it for? It was for rent. So we'll do rent revenue as our credit, some type of revenue count. There you go. The next one was to correct the error. Hey, we did that one already. So rewind the video and we see that we needed to add an additional expense of $234 and take out an additional amount of cash of $234. So that's my correcting journal entry. So let's just copy that over. We already did that. Analysis. I don't know why a Q got there. There we go. All right, sweet. Next we have is the non-sufficient fund check. So that was when the customers, their checks bounced for $50. Now let's check this off because we already counted for that one. We're doing this one now. And they didn't clear. The customers still owe us. So we had originally, when we got the $50 from the customers, we said, yay, we got $50. This is what the accountant did, the journal entry. They said, yay, we got $50. And they debited cash by $50. And they said, well, that customer no longer, this is accounts receivable, that customer no longer owes me $50. So they decreased this asset account. Remember, that was an asset account. And they decreased it with a credit because now they're not looking for $50 from that customer anymore because I gave them the money. Well, the check bounced. And so we really didn't get the money. So we need to actually reverse out this entry. We need to say, well, the customer still owes me, so we'll have to do a debit to accounts receivable. I'll write it in typing because I know that's super sloppy. And we'll have to say, well, we really didn't get the money, so we'll have to take it out of cash. So we're doing a flip. So let's go ahead and do that. I like a reversing entry. There you go. That's that journal entry. Next we have is those two bank expenses. That's what we're going to call it. One was for the printed checks, and then the other one was the bank service charge. And so we just need to record that additional bank expense. They're saying do it as two separate entries for your book. So let's go ahead and do it that way. If you combine them, that's okay, but this is how the particular textbook wants it done. So the first one was for $23, so we'll decrease. Let's go back up there and show you that real quick. And then the other one was for $7. So we can see we're doing the $23 one now. And then the other service charge is another bank expense. Both of them will be bank expenses. That's the 23. And then this one down here, same thing for $7 instead. All right, perfect. We are all done with our bank rec. We did a bank reconciliation, at least for the common type of items that you will see. And then we did our adjusting journal entries to fix our cash balance. All we did was to adjust our cash balance so we can get to this ending balance. So all these items that we did here, we went ahead and recorded, so that way this previous balance will get adjusted, and now our cash balance on the balance sheet will be for $2,270 because of those differences that we didn't know about and we noticed on the balance on the bank statement. All right, perfect. So no journal entries, again, as just reinforcement, no journal entries done for the bank side. We only did the bank side to make sure we got to that adjusted balance. So that way we know we accounted for everything for the book side, for correcting our books. All right, so that is it for this video. And up next will be chapter 8.